Welcome to a brand new video where we delve into the world of investments and dividends. Today we're turning the spotlight on a much buzzed about financial instrument, exchange-traded funds or ETFs. These are marketable securities that track an index, a commodity, bonds, or a basket of assets like an index fund. They're designed to offer investors a way to pool their money in a fund that makes investments in stocks, bonds, or other assets as per its charter. And why are we interested in them? Because they offer a unique blend of the diversification benefits of mutual funds and the flexibility of stocks. But not all ETFs are made equal. Some stand out more than others, especially when it comes to monthly dividends. So, if you're looking to expand your portfolio or simply curious about the investment landscape, you're in the right place. Stay tuned as we uncover the 5 best monthly dividend ETFs for 2025. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. Let's commence with our first ETF, the JP Morgan Equity Premium Income ETF, better known as JEPI. JEPI is an exchange-traded fund that seeks to provide investors with regular income by investing in high-quality, large-cap equity securities. It's a strategy that combines the potential for capital appreciation with a monthly income stream, which makes it an attractive option for those looking to supplement their income. The JP Morgan Equity Premium Income ETF is part of the larger JP Morgan Chase & Company, a leading global financial services firm with assets of over $2 trillion. This powerhouse backing provides investors with a sense of security and reliability. But what makes JEPI stand out? Well, it's all about the strategy. JEPI uses a unique approach known as a covered call strategy. This involves owning or buying stocks and then selling call options on those stocks. It's a way of selling the options, hence the name Equity Premium Income. In terms of performance, JEPI has been delivering consistent returns since its inception. It has a solid track record of not just preserving capital, but also providing growth. This is achieved by a careful selection of stocks and diligent risk management. Now, like any investment, JEPI comes with its share of risks. The primary risk is market risk, where the value of the ETF securities may go up or down in response to the prospects of individual companies and/or general market conditions. There's also the risk associated with the covered call strategy. If the underlying stocks rise significantly, the ETF may not participate fully in the upside because it has sold call options on those stocks. However, the potential benefits of JEPI often outweigh these risks for many investors. The monthly income, potential for capital appreciation, and the backing of a reputable financial institution like JP Morgan Chase make JEPI an attractive option for those seeking to diversify their portfolio and create a steady income stream. That's JEPI for you, a solid choice for any investor looking for monthly income. Next on our list is another gem from JP Morgan, the Equity Premium QD ETF, or JEPIQ. Diving into the world of exchange-traded funds, JEPIQ stands as a beacon of potential and reliability. Launched by JP Morgan, one of the most respected names in the finance industry, this ETF aims to provide investors with exposure to a diverse portfolio of quality stocks. So, what makes JEPIQ stand out? Well, it's all about the strategy. JEPIQ employs a unique quantitative approach, focusing on quality and low volatility factors. This means it targets companies that not only have a robust balance sheet, but also demonstrate lower fluctuations in their stock prices. This strategy can be particularly appealing to investors who wish to mitigate risk and seek stable returns. Now, let's talk about performance. Historically, JEPIQ has delivered impressive results. Its consistent performance can be attributed to its diversified portfolio, which spans across various sectors. From technology to healthcare, from consumer goods to financial services, JEPIQ's broad exposure helps to cushion the impact of sector-specific downturns and capitalize on market opportunities. But remember, as with any investment, JEPIQ comes with its own set of risks. Market volatility, changes in interest rates, and shifts in the economic landscape can all have an impact on the ETF's performance. Therefore, it's crucial to do your homework and understand these potential risks before diving in. Yet the benefits of JEPIQ often outweigh these risks. Its focus on quality and low volatility stocks, coupled with its diversified portfolio, make it a compelling choice for those seeking to build a resilient investment portfolio. Additionally, JP Morgan's expertise in asset management further bolsters investor confidence in JPQ, so whether you're a seasoned investor or just starting out, JPQ offers an intriguing blend of stability and potential growth. It's an ETF that doesn't just provide exposure to the stock market, but does so in a way that's designed to manage risk and optimize returns. JEPQ, another reliable ETF from JP Morgan, is certainly worth considering. Moving on, we have the WisdomTree U.S. Quality Dividend Growth ETF, more commonly known as DGRW. DGRW is an exchange-traded fund managed by WisdomTree, a well-known player in the ETF market. WisdomTree is known for its unique approach to the development of ETFs, focusing on dividend-paying stocks, and DGRW is no exception. DGRW is designed to track the performance of the WisdomTree U.S. Quality Dividend Growth Index. This index is a fundamentally weighted index that focuses on U.S. companies with high long-term earnings growth expectations. These are companies that not only have a history of paying dividends but also show the potential for future dividend growth. Now let's talk about performance. Over the past 5 years, DGRW has shown consistent growth, outperforming many of its peers. This is a testament to the high-quality dividend-paying companies that make up its portfolio. However, it's not all about past performance. A look at the current holdings of DGRW reveals a diverse portfolio, with top holdings in the information technology, healthcare, and consumer discretionary sectors. This diversity provides a level of protection against market volatility, making DGRW a potentially safer choice for investors looking for both income and growth. There are, of course, risks associated with investing in any ETF, and DGRW is no exception. The fund's focus on dividend growth means that it may perform poorly during periods of market downturns when companies may cut dividends. Additionally, while the fund's diverse portfolio provides some protection, it also exposes the fund to a variety of sector-specific risks. But the potential benefits of DGRW are compelling. With its focus on quality, dividend-paying companies, DGRW offers the potential for both income and capital appreciation. Moreover, its diverse portfolio and robust performance make it a promising choice for those seeking long-term growth. In conclusion, DGRW is a unique offering in the ETF market, combining the income potential of dividend-paying stocks with the growth potential of high-quality companies. Like any investment, it comes with its own set of risks, but for those willing to take them on, the rewards could be substantial. DGRW proves to be a promising ETF, especially for those seeking long-term growth. The fourth ETF on our list is the Amplify Yield Shares CWP Dividend and Option Income ETF, or DIVO. This intriguing fund is designed to provide investors with exposure to a portfolio of high dividend-yielding U.S. securities, while also seeking additional income through a covered call and put option strategy. In simpler terms, DIVO aims to offer both capital appreciation and income generation, a tantalizing combination for any investor. DIVO's performance has been noteworthy. It has consistently delivered a solid return, outperforming many of its peers. This can be attributed to its strategic blend of dividend-paying stocks and options trading. These two components work in harmony, with the dividends providing a steady income stream and the option strategy contributing an additional layer of potential returns. One of the key benefits of DIVO is its monthly distribution. For those seeking regular income, the frequency of these payments can be particularly appealing. However, it's worth noting that the amount of these distributions can vary, depending on the performance of the underlying securities and the success of the options strategy. In addition to this, DIVO's unique approach can serve as a buffer against market volatility. The fund's option strategy can generate income even in flat or declining markets, and the focus on high dividend-yielding stocks can provide a degree of stability. But, as with any investment, DIVO carries potential risks. The fund's reliance on options means it's subject to the risks associated with this type of trading, including the potential for losses if the market moves against the fund's positions. It's also worth noting that while the fund's focus on high dividend-yielding stocks can offer some protection against market downturns, these stocks can underperform in a rapidly rising market. In conclusion, DIVO, with its unique strategy, is an interesting choice for those looking for a bit of diversity. It offers the potential for both income and capital appreciation. While its approach can provide some protection against market volatility, as always, it's crucial to consider your own risk tolerance and investment goals before diving in. Last but not least, we have the SPDR Dow Jones Industrial Average ETF, otherwise known as DIA. The DIA ETF is a hallmark of the exchange-traded fund landscape. It's designed to, before expenses, generally correspond to the price and yield performance of the Dow Jones Industrial Average. This means that when you invest in DIA, you're essentially investing in a slice of the 30 blue-chip U.S. companies that make up the Dow Jones Industrial Average. One of the great benefits of DIA is its exposure to a broad, diverse range of sectors, from technology to healthcare, industrials to consumer discretionary. This ETF covers a lot of ground. It's like having a little piece of the entire U.S. economy in your portfolio. Moreover, its focus on blue-chip companies means that it invests in some of the most established and stable companies in the market. These are companies that have stood the test of time, weathered economic downturns, and continue to provide consistent returns. It's worth noting that DIA is a large-cap ETF, meaning it invests in companies with large market capitalizations. This generally translates to less volatility than you might see with smaller, more speculative investments. But, like all investments, DIA comes with its own set of risks. The ETF's performance is tied to the performance of the Dow Jones Industrial Average, which means it can be affected by overall market volatility. Additionally, because it's so diversified across sectors, it may not offer the same level of returns as an ETF focused on a particularly high-performing sector. Despite these risks, DIA has proven to be a strong performer over the years. It's a popular choice among investors for its reliability and its ability to provide a snapshot of the U.S. economy. In conclusion, DIA offers a unique blend of diversity, stability, and potential for growth. Whether you're a seasoned investor or just starting out, DIA is a dependable choice, especially for those looking to invest in the broader market. So there you have it, the 5 best monthly dividend ETFs for 2025. Let's take a quick walk down memory lane and revisit the fantastic 5 we've discussed today. Starting with the JP Morgan Equity Premium Income ETF, JEPI. This ETF provides a robust and reliable income stream, making it an attractive option for those seeking a consistent return on their investments. Next up, we have the JP Morgan Equity Premium QD ETF, JEPI. This ETF stands out for its unique quantitative and derivative strategy, which can be a game-changer for investors looking to diversify their portfolios. Moving on, we've got the WisdomTree U.S. Quality Dividend Growth ETF, DGRW. This ETF focuses on quality and growth, a combination that could be the winning ticket for investors looking for long-term gains. Then we have the Amplify Yield Shares CWP Dividend and Option Income ETF, DIVO. This ETF is a real contender for those seeking a blend of income and growth. It's a solid choice for those looking to supplement their income while also growing their investment over time. Lastly, the SPDR Dow Jones Industrial Average ETF, DIA, a classic that offers exposure to some of the largest and most established companies in the U.S. It's a tried-and-true option for those wanting a stable and reliable investment. In the world of investing, knowledge is power. Understanding these ETFs, their strategies, and how they can fit into your investment goals is key. Remember, each investor's path is unique. It's about finding the right blend of risk and reward that suits your individual needs and aspirations. Investing is not a one-size-fits-all journey, but with the right tools and understanding, you can make informed decisions that align with your financial goals. These 5 ETFs represent some of the best monthly dividend options for 2025, but always remember to do your own research and consult with a financial advisor if needed. Remember to subscribe, like, and share our video. Thank you for tuning in, and see you in the next one.